fixed production overhead variance. We are going to find fixed overhead total variance. It is constituted by fixed overhead expenditure variance and fixed overhead volume variance. So, let us start doing the solution, and before making the solution, let us work on the chart which shows this variance. FOH represent fixed overhead total variance. So, dear friend, we are finding the fixed overhead total variance. So, let us work the formula for that, and then we will work all the element of this variance. So, this is actual fixed overhead I correct myself, it is absorbed fixed overhead minus actual fixed overhead. So, fixed overhead total variance, this is composed of two elements. Number 1, fixed overhead expenditure variance and fixed overhead volume variance. The fixed overhead expenditure variance can be shown by the formula budgeted fixed overhead minus actual fixed overhead, and fixed overhead volume variance is shown by absorbed fixed overhead less budgeted fixed overhead. BFOH represent budgeted fixed overhead. This volume variance can be broken down into three parts. The three parts are fixed overhead capacity variance, fixed overhead calendar variance. So, when word calendar comes, it is basically a time variance, and fixed overhead efficiency variance. The fixed overhead capacity variance is shown by budgeted fixed overhead for actual hour minus possible fixed overhead. Fixed overhead calendar variance is shown by possible fixed overhead minus budgeted fixed overhead. Fixed overhead efficiency variance is shown by absorbed fixed overhead minus budgeted fixed overhead for actual hour. So, friend, this chart reflects the fixed overhead possibility in terms of different variance. Now, we are moving to the numerical and trying to figure out how these variances are calculated. So, let us read question number 4. The question says, in a manufacturing company, the standard units of production of a year were fixed at 1,20,000 units, and overhead expenditures which were estimated, they were estimated for fixed overhead at rupees 12,000, variable overhead at rupees 6,000, semi variable at rupees 1,800. The actual production during the month was 8,000 unit. You have 20 days in a month, which is actually working days. During the month, there was one statutory holiday, a government holiday you can say. The actual overhead amounted to following: fixed overhead 1190 rupees, variable overhead rupees 480, semi variable rupees 192. The semi variable charges are considered to have 60% fixed component and 40% variable component. Now, you are required to compute certain things. Number 1, overhead cost variance. Number 2, fixed overhead cost variance. Number 3, variable overhead cost variance, fixed overhead volume variance, fixed overhead expenditure variance and calendar variance. So, examiner is asking you to calculate 6 things. So, now let us start working one item after another. So, we are going to do all the 6 items 1, 2, 3, 4, 5 and 6. So, the first item what we are going to pick up is overhead cost variance. This is absorbed fixed overhead minus actual fixed overhead, right? So, what we do? We put the figures given there at rupees 872 plus 448 minus rupees 1305.20 plus 556.80. So, if you solve it, what you get? You get a value of rupees 542. Is it favorable or adverse? It is adverse. So, we have done first part of the solution. The second part asks you to compute variable overhead cost variance. So, this is standard variable overhead for production minus actual variable overhead. So, this becomes rupees 448 minus rupees 556.80. On solution, this becomes rupees 108.80 adverse. So, this is the second part of the solution. If you look the third part, the question is asking for the following. The question is asking you to compute the fixed overhead cost variance. So, fixed overhead cost variance, this is already known to you. This is absorbed fixed overhead FOH minus actual fixed overhead. So, when you solve rupees 872 minus rupees 1305.20, this becomes rupees 433.20 adverse. So, this is the third part of the solution. The next part asks you to find out the fixed overhead volume variance. So, if you see the formula in the chart given above, for volume variance you have this formula: absorbed minus budgeted fixed overhead. So, I put the figure straight away: 872 minus 1090. So, this becomes rupees 218 adverse. The fifth formula is fixed overhead expenditure variance. This is budgeted fixed overhead minus actual fixed overhead as shown above. So, in this case, if you see, the solution which is going to come is to be found. For this particular aspect, we need to have a working note. So, let us do a working note. So, the fixed overhead can be found as budgeted fixed overhead divided by budgeted output. So, you have rupees 12,000, you have 1,20,000 units. So, this becomes 0.01, sorry 0.10. First, now 60% of 1800 is 1080, which is fixed overhead element in semi variable cost. The third working note you have to do, you have to get fixed overhead for the variable portion. So, fixed overhead is 1080. So, when you solve it, this comes 0.009, and final thing you have to find out is standard rate of absorption of fixed overhead per unit. This is 0.1 what you have got plus 0.009. So, this becomes 0.109. So, this value we will be applying in this calculation. So, 0.109 multiplied for 10,000 units minus 1305.20. So, if you solve, this is 215.20 adverse. Last part is calendar variance. This is time. So, possible overhead minus budgeted fixed overhead. So, possible overhead is given at rupees 1035.50 minus rupees 1090. So, if you solve it, this becomes rupees 54.50 adverse. So, friend, we have done the solution to the problem